11:52 p.m. You open your phone. Not because you want to, just out of habit, a nearly unconscious reflex. Your finger touches the screen before you even have time to think about what you're looking for. The number appears immediately, down 28%. You don't need to read it again. Your brain processes it faster than your awareness does. You know exactly what it means before you can even name the feeling. Not a sharp crash in a single day. It isn't dramatic like that. It has been sliding down, little by little, over several weeks, a little each day, small enough that you don't panic right away, but steady enough that you can't ignore it. No noise, no warning, no one calls to say, maybe you should take another look. It's just the number, continuing to fall. Another notification appears right above it. Email. Subject, organizational restructuring. No greeting, no long explanation, no sign of concern, just an attachment. You open it. A list. You scroll down. Your eyes move faster than usual. Not to read, just to search. You're not looking for information, you're looking for your name. And then you see it. There is no special sound in your head at that moment, just a blank space. A minute later, your phone vibrates again. Not a notification, a call. You already know what it is, even before you answer. We need you to deposit $12,000 before 9 a.m. tomorrow to maintain the position. The voice on the other end has no emotion. It doesn't need to. It's just executing a process. You look back at the account. 43,000, 31,000, 29,700. The number doesn't stay still long enough for you to get used to it. You try to calculate quickly in your head. You do not have $12,000. Not that fast. Not within a few hours. Not when your income just disappeared a few minutes ago. Somewhere else, at that exact same moment. No one is opening an email. No one is getting that kind of call. A buy order is being prepared. Not 12,000, 12 million. Not to save, but to buy, to absorb, to take what has just been forced out. Same price, same market, same moment, but entirely different experiences. You think you were looking at the market, but in reality, you were looking at your position inside it. And the market does not only measure how much money you have, it measures how long you can endure. It measures whether you have the right to wait. You've heard about compound interest before, maybe in a classroom, a teacher drawing a curve on the board, slow at first, then rising sharply. Maybe in a video, someone calling it the eighth wonder of the world. Maybe just in a chart you scrolled past, without ever really stopping to understand it. It sounds very reasonable, very clean, very neat, very fair. You put money in, you invest, you wait. And over time, the money begins to work for itself. It sounds like a system where if you just do it right, the rest will operate on its own. But this video is not really about compound interest in that way. It is not about your account growing steadily year after year. It is not about how, if you are patient enough, everything will be fine. It is about something that is rarely mentioned. Who actually has the ability to stay in the system long enough for compound interest to work? It is about the gap between two states that look the same on paper, but in reality are completely different. Being able to wait and being forced to act. Two people can understand the same principle, read the same book, watch the same video. But one person builds wealth. The other leaves the game before the curve even has time to rise. And more importantly, money does not multiply itself democratically. It does not care whether you are right or wrong. It moves according to structure, according to access, according to the ability to survive stretches of time that most people do not make it through.
If this story changed the way you see money, subscribe for more deep story about finance, power, and the system behind it.
On the surface, the rules are very simple. Simple enough that you can summarize them in a few lines. You earn money. You spend some of it. You keep some of it. You put it into a savings account. You open an investment account. You buy an index fund. You turn on dividend reinvestment. You let it run. Each month you add a little more. Each year you look back and see that it has grown. You are taught that if you do this long enough, the system will reward you. And the truth is, that is not wrong, but it is also not the whole truth. Because while you think you are investing, your money is not sitting still. It is being pooled, combined with that of millions of others, allocated into places you do not see, used as part of a capital flow far larger than you imagine. You are not just an investor. You are a source of liquidity, a small part of a system that needs continuous capital flow to operate. You do not make the rules. You do not define the conditions. You do not decide when the market opens or closes. You simply step in and accept the rules that existed before you arrived. And most of the time, you are told that the only thing you need to do is nothing at all. Don't sell. Don't panic. Think long term. Those statements sound very right. And in many cases, they really are right. But they rely on one very large assumption, that you have the ability to stay, that you have enough breathing room, that you are not forced to leave when things become difficult. And that is not something everyone has. This is where the real rules begin to show. Two people reading the same book, learning about compound interest, believing in the idea that all you need is enough time. One person has 12 months of living expenses saved. No debt, no immediate cash flow pressure. The other is making monthly debt payments, has a loan coming due, has a family depending on them, has expenses that cannot be delayed, does not have much room to breathe. The market drops 25%. On paper, that is just a number. But in reality, it is not just a number. For the first person, it is volatility. For the second, it is a chain of forced decisions. He loses his job right when the market falls. No warning, no better timing. Income stops. Expenses don't. He opens his portfolio again, not as a long-term strategy, but as the only source of money left. He sells. Not because he doesn't believe in compound interest, not because he lacks discipline, but because he has no choice. On the other side, the person with a buffer does not sell. They may even buy more, not because they are braver, not because they understand the market better, but because they have the ability to endure longer. Same principle. Two outcomes. Compound interest did not fail, but before it even had time to begin, one person had already been pushed out of the game. To understand why two people can learn the same principle yet end up in completely different positions, you have to look beneath the surface of those numbers. Not the curve, not the chart, but the flow. Money does not stand still. It is always moving. You put money into a bank. To you, that is saving. A simple act. Put it in, leave it there, safe. But to the system, that is raw material. The bank does not keep your money in a vault. It gathers those small deposits together, millions of them, and turns them into credit. Part of it becomes someone else's mortgage. Part of it becomes working capital for a business. Part of it goes into more complex structures, places you will never see, and were never meant to see. You contribute to a retirement fund, 401k, IRA, pension. You think you are preparing for your own future. And yes, part of that is true, but at the same time, your money is being pooled into massive funds, billions of dollars. Those pools do not operate on their own. They are handed to people whose names you do not know. Allocator, manager, advisor. They allocate capital. From one fund to another, from one asset to another, from stocks to bonds to private credit to private equity. At every step, there is a gap, a spread. Not large enough for you to notice in a single transaction, but stable enough, repeated enough, over enough time to become a distinct stream of profit on its own. You see 7%, 8%, 10% a year. They see cash flowing through a system. This is the first layer, the flow of money. But money does not choose its own path. They decide who gets to participate, how much money is enough, what level of risk is appropriate, whether you are allowed in or kept outside. An investment product is not just an opportunity. It is a structure, a set of conditions, a fence. There are doors you cannot open, not because you are not smart enough, not because you do not try hard enough, but because you do not qualify. Not enough assets, not enough income, not enough relationships. You are given what has already been packaged, already simplified, already cleaned up to fit you. On the other side, there are deals that never appear in front of you, not because they are hidden, but because from the beginning, they were never designed for you. This is the second layer, the flow of power. And then comes the third layer, where everything becomes clearest, when the system is tested. When markets rise, almost everyone wins. The differences stay hidden. Everything. Loans coming due, living expenses, cash flow pressure. They don't sell because they want to. They sell because they have to. Forced sellers. On the other side, someone is waiting for that exact moment. Not because they are smarter, but because they are standing in a different position. One is forced to liquidate. One absorbs liquidity. Price is not just a number. It is the intersection between compulsion and choice. And if you watch long enough, you begin to see a repeating pattern. When things are normal, money flows downward. When there is a crisis, assets flow upward. Retail does not disappear from the system. They become its final layer of absorption. You are not removed from the game. You are kept in it, but in the exact position the system needs you to be.
Subscribe for more story about money, power, and the system.
At some point, if you stay long enough, you begin to change. Not immediately. There is no clear moment, just gradually. At first, you believe in the simple story. Work hard, save, invest, be patient. Everything will be fine. You see the market as an open field. Everyone has a chance, as long as they are disciplined. You read books, you compare funds, you optimize costs. You do everything right. And then you start seeing things that are not in the books. You see people who don't need to check their accounts every day. You see investments that never appear in any app you use. You see tax structures no one ever taught you. You see decisions not made to maximize returns, but to preserve position. You don't change overnight. You don't suddenly become skeptical, but a part of you begins to adjust. You no longer look at every price drop as a simple opportunity. You begin to ask, who is being forced to sell at this price? You no longer believe the market is always fair. You begin to understand that it is efficient in a different way. Efficient in redistributing assets. You no longer think investing is just a skill. You begin to see it as a system of incentives. And to survive, you have to change how you react. You become more disciplined, but also colder. You become more patient, but also less expressive. You begin to optimize not just your portfolio, but the way you exist within the system. Some conversations become difficult, not because you have more money, but because you no longer see money the same way. You no longer see it as just a means of consumption. You see it as position. You don't know exactly when you changed. You just know you are no longer the person you were at the beginning. And then, at a certain threshold, everything does not just change in quantity. It changes in nature. It's not that you have more money to buy the same things. It's that you begin to enter a different world. public markets are no longer the entire picture. Private deals begin to appear, not through advertisements, not through apps, but through invitations. Minimums are no longer a few hundred or a few thousand, but 50,000, 100,000, 250,000. Not because they are better in the way you think, but because they are structured differently. Longer lockup periods, lower liquidity, less transparent information. But in exchange, you participate earlier in the value chain. Capital of a certain size changes the type of assets. The type of assets changes the type of relationships. You begin talking to people who do not appear publicly. Allocator, manager, advisor, insiders. The conversations are no longer, what should I buy? But who is doing this deal? Relationships change and create a layer of protection. You are no longer alone in volatility. You receive information earlier. You have better structures. You have more choices. And that layer of protection changes how you experience crises. When the market falls, you don't just look at the loss. You look at your position. You know how long you can wait. You know whether you are forced to act. You know which side of the flow you are on. This is no longer a story about investing. It is a story about position. And then, at some point, if you look long enough, you begin to see something difficult to accept. The problem is not that you haven't done well enough. The problem is you are believing in a story that does not exist. You were told the market is fair, that everyone has equal opportunity, that if you do things right, you will be rewarded. It sounds reasonable. But this system is not designed for fairness. It is not designed for everyone to see the same information, not at the same time, not from the same perspective. It is not designed for everyone to compound equally. Those things are just the story. So that you accept the rules without asking who wrote them. What this system actually optimizes is stability at the top. Large structures must survive. They cannot collapse every time there is volatility. So the system absorbs shocks before they reach the most important layers. It optimizes for liquidity, but not for everyone, for large capital, so they can move quickly, at scale, at the right time. And most importantly, it optimizes for its own continuity. What already exists continues to exist. Positions that already exist are protected, not by one clear law, but by thousands of small rules. Access thresholds, participation conditions, the way information is distributed. You do not see the whole thing, but you are living inside its outcomes. And once you understand that, many things begin to make sense. Why you do things right, but still find it hard to accumulate. Why every time the market moves, you feel pressure, while somewhere else, someone is waiting for that exact moment. Why just hold long term sounds right, but is so difficult that many people never reach the point where it starts to work. Not because they lack discipline, but because life does not allow them to wait. Costs rise, loans come due. One small disruption is enough to break the plan. Volatility, for you, is risk. For someone else, it is supply. You are looking at the same price drop, but you are not playing the same game. And that is why many people feel like they are always one step behind, even when they are not clearly doing anything wrong. Because the problem is not technique, it is structure. You are operating inside a system that is not designed for you to win. That does not mean you cannot move forward, but it does mean you have to see things differently. You have to understand, compound interest is not just a formula. It is a selection mechanism. It keeps those who can endure long enough and removes those who cannot. And when you return to the beginning, you will see a familiar image. Someone opens their first account, sets up automatic transfers, feels like they are doing the right thing. They are not wrong. But they have not seen the whole picture. They think this is about money growing over time. They do not see what is being tested is how long they can stay. They do not see the hardest part is not choosing the right investment, but not being forced to leave before it has time to work. And that is where everything closes. The market does not reward those who are right. It rewards those who remain. If you want to understand more deeply how this system actually works and how to find your position within it, stay with this channel.
If this story changed the way you see money, subscribe for more deep story about finance, power, and the system behind it.